Hi, I'm David Dickens, and this is our March 2018 economic update. So consumer confidence hit a milestone this last week. It eclipsed the level that it was last reached in November of 2000, so almost an 18-year high in consumer confidence. A lot of that was driven by a big surge in employment in January, followed by a nice surge in January. So the economy added over 313,000 jobs in February. That was on top of 200,000 that was added in February. Another positive is that the participation rate of people that are able to work, that also hit a 6-month high. Wage gains are growing at an annualized rate of 2.6%, which is a positive for consumer confidence, since that's above the inflation rate. It's also down from last month's 2.9% annualized increase. That's a positive for people that are concerned about runaway inflation or inflation growing. So there's a little bit of something to like for everybody in that report. Jerome Powell took over at the Federal Reserve Bank early February, and he was greeted over the next 2 weeks by a 3,000-point drop in the Dow Jones Industrial Average. So they've been talking about 3 to 4 rate hikes this year, and now they've dialed that back to maybe only 2 to 3, which would also be a positive for the stock market. They are continuing on their balance sheet reduction plan. That's the opposite of quantitative easing. They've been growing their balance sheet since 2009 to try to prop up the economy. They grew it from about $400 billion all the way to $4 trillion, and now they're starting to remove those assets by selling them. The faster they sell, the worse it is for the stock market. So some moderation there is a good thing. If you were watching the market at all in February, you know that it had more than a 10% drop. So that ended a streak of 13 straight months where the market just went up. So that 10% correction was way overdue and a very, very healthy thing. Business confidence remains high. Corporate revenues continue to grow. Corporate earnings continue to grow. And the tax reform is probably going to create an increase in corporate buybacks. All of those are positives for our stock market for the rest of 2018. When you look at volatility in the stock market, it seems like it's just exploded in February. But if you take a look at the last 60 years of market history, on average, in each of those 60 years, there were 53 days where the market went up or down 1%. 53 days. In 2018, there were only 8. So 2017 was a dramatically low volatility market. So far in 2018, we've already had 12 days with more than 1% volatility. So I think what we're getting back to is more normal and not outsized volatility. So just be prepared for more of that as we expect a more volatile but a continued upward move in 2018. Couple of reminders for you. If you're wanting us to do your taxes this year, we're more than halfway through tax season. So if you want to get on the calendar, make sure you call Melody or Elizabeth and let us know that. If you weren't able to come to our State of the Markets meeting on March 6th, you missed a really good meeting, but there's some upcoming opportunities. So make sure you watch our weekly newsletter and our website for some coffee connections, some lunch and learns, and maybe a wind down Monday or two. So I hope you have a terrific March. I hope your favorite basketball team wins the whole thing, and we'll look forward to seeing you again in April.